Treasury stock. Let's assume that a corporation issues 10,000 shares for $100,000. In other words, each share is issued at $10 per share. Later, corporations might reacquire their own stock for several reasons, such as acquiring it to offer it to its employees. Or the corporation might create demand on the stock to support its price. The corporation buys the stock by its market price. So if it bought the stock for $12, it could be regarded as it had lost $2, since the corporation bought the stock at a price higher than when it issued it. If the market price is $7, for example, the company is regarded as making a profit from such a transaction, since it had bought back the share at a lower price than the issued price. However, a corporation is not allowed to make loss or profit from buying its own shares. To illustrate how to account for such transactions, let's assume that a company issued 10,000 shares for $10 each. The company would debit cash and credit common shares for $100,000. The company decided to reacquire 1,000 shares back at $9 each, so it paid $9,000 to investors to reacquire the shares. The corporation is regarded to have gained $1,000. However, a corporation is not allowed to gain or lose from its own stock. The amount is added to a special shareholders' equity account called contributed surplus. The company would record this transaction by debiting the treasury stock for $10,000. Treasury stock is a contra shareholders' equity account, so its normal balance is debit. The company would credit cash for $9,000 and credit contributed surplus for $1,000. The shareholders' equity section on the statement of financial position will be presented as follows. Common shares is $100,000. Let's assume that retained earnings is $30,000, contributed surplus $1,000, and treasury stock is subtracted for $10,000, as it is a contra shareholders' equity account. So the total shareholders' equity is equal to $121,000. Let's assume that the company reacquired another 1,000 shares when the share was traded at $13. We cannot still regard this as a loss. The company debits common shares for $10,000. It will debit contributed surplus by the amount previously credited to it until it becomes zero. So it will be debited by its balance, which is $1,000. The remaining $2,000 are deducted from retained earnings. So retained earnings are debited as well. Cash is credited for $13,000. The company debits treasury stock for $10,000. It will debit contributed surplus by the amount previously credited to it until it becomes zero. So it will be debited by its balance, which is $1,000. The remaining $2,000 are deducted from retained earnings. So retained earnings are debited as well. Cash is credited for $13,000. The shareholders' equity section on the statement of financial position is presented as follows. Common shares are $100,000. Retained earnings new balance is $28,000. Contributed surplus is now equal to zero, and the treasury stock is subtracted for $20,000, as it is a contra shareholders' equity account. So total shareholders' equity is equal to $108,000. In Canada, corporations are expected to cancel shares after reacquiring them. Companies deduct the shares that they reacquired directly from the common shares instead of using a treasury contra shareholders' equity account. All other things are exactly the same.